All right, everybody, welcome back to the Cashflow Chronicles. I don't think Chris is going to make it tonight, so I know that's going to upset a lot of you guys, but hopefully we can still do some good due diligence with respect to going into him stock and a few other items that I wanted to kind of bring up this evening. Um, yeah, we'll probably spend a good minute or two just kind of going through the market at the moment, some updates on Palantir, things of the like, and then eventually we will probably also touch on him stock, of course. And there's one or two other items that I wanted to touch on, but we'll probably just get into it and hope things continue to go well for us here at the Cashflow Chronicles. So, first thing I wanted to highlight is specifically, let me share my screen for you guys here. The first thing I wanted to highlight is why do I have so many dang things open? Okay. So if you go specifically into LinkedIn, some of you guys are probably on LinkedIn, some of you guys probably are not. But I was just scrolling through this morning and I saw another announcement. I was like, this has to be fake, right? So this is basically talking about a White House and Commerce Secretary effort to advance AI and things alike. And so this isn't just big news for Palantir, right? This is big news for a lot of companies. So if you actually open up what they're talking about within here and you actually go through the article itself, it says a lot. It says a lot with respect to other companies that are also getting awarded contracts within here. It's talking about how they want to harness the benefits of AI and a lot of other things in here. And so I was like, okay, well, what companies are actually getting commitments from the White House, right? So you have Adobe, Cohere, IBM, NVIDIA, which is a really big proponent in AI, as everybody's relatively known in that, Palantir, Salesforce, Scale AI, and Stability, and that help drive safe, secure, and trustworthy developments of AI technology. So this is pretty cool, right? I'm confused as to why they might not necessarily have a Microsoft or they don't have a Google or something of the like. And so I'm not sure if these particular companies are providing a service that is, let's just say, different than what Microsoft or Google are potentially offering. And so with that, pretty tough to kind of understand why not everybody's kind of getting an even go at this. But I think that this is taking an opportunity to look at security testing and stuff of the like. So if you're talking about security testing specifically, why isn't a Microsoft or any of these other IL6 sort of companies being involved in that conversation as they've gone through rigorous testing, but maybe it's not necessarily specific to um, government sort of testing, right? Where IL6 is really important. Maybe it's talking about just general security testing and stuff of the like, and they really like Palantir's uh what am I looking for? Palantir's sort of way about going through those things. Commitment to sharing information across the industry with governments, civil society, academia, and managing AI risks. So maybe it's a possibility that these guys didn't want to play nice when it comes to like Amazon, Google, Microsoft. They didn't necessarily want to play nice with respect to, providing an open book when it comes to sharing information across. And when I say Microsoft, I'm talking about OpenAI and Microsoft, right? So I kind of use them. I don't want to say synonymously because they are different companies, but at the end of the day, Microsoft is really leveraging their investment with respect to OpenAI there. Building systems that put security first, enabling the public trust. Um, so this is a pretty interesting one because with this, it looks like that they're consulting with other countries as well to kind of formulate some bigger um, G7 sort of leadership position esque sort of thing, forming a global partnership, if you will, with respect to AI. So I thought this one was really cool. And I wanted to bring this to everyone's kind of light because I don't know if I've really seen this. I haven't been on Twitter much today, but I thought that this one might be one to kind of look at. Another one was one, I need an iPhone. I have the iPhone XR, and so it was cool to see Apple release an iPhone with a USB-C charger, because I'm tired of my Lightning ports chargers just completely going up in smoke. And so with that, I saw some other opportunities for potentially India to create their first iPhone instead of China. And so that kind of decoupling of Apple and China, and continuing down that sort of rabbit hole, I thought was something that was peculiar, and especially with the news that Chinese officials in the government can no longer utilize iPhones as a whole. So I thought that coupled well together, but not in a good way, more so in a bad way. So I briefly did a little bit of work on hymns, and nothing too extravagant, right? And a lot of it's just kind of the blind eye test comparatively to what the kind of earnings report are, and they do a really good job uh, when it kind of comes to where they were over the past several quarters to where they are now, and where they continue to potentially look for. And I just did some brief estimates. And with that, you can start to kind of formulate whether or not things are rather cheap from an organizational perspective or not. And so let me just pull up a quick um, view of hymns in terms of the price and what things are kind of looking at. And I know other people are a big proponent of this. I'm not trying to devalue any of the work that other people have done or anything of the like. It's just me kind of doing an independent assessment. I had some people reach out to me and said, "Hey, I'm curious what your thoughts are on hymns." And I personally have never looked at it. I've seen it quite a bit from other folks that are looking through the market trying to look for things. And I know when 2Q came out, everyone was really excited. So you can see in the last 5 years or so, they're down about 33%. But year to date, up, kind of even. Past year, down 3%. The past month, down 7%. And so they've seen their peaks and troughs, I anticipate, just associated with the normal, sharing of news and everything of the like. So if any of you guys don't really know necessarily about what the company does, I'm not really too familiar with it. I see their advertisements all the time on Instagram, and I know that they've also started to expand into the female side of providing. So now they're kind of calling themselves Hims and Hers when it used to be Hims. Maybe they've always done Hims and Hers, but it's just interesting that now they're kind of doubling the market, which I think is pretty cool. If they were only specifically focusing on Hims before, right? Because I've only really seen it advertised as Hims. So anyway, so Hims and Hers operates a telehealth consultation company, and they basically are healthcare professionals enabling to access medical care for mental health, sexual health, skin care, and just normal primary care. So I think it's just a different way to kind of access health. And everything that I've kind of seen on Instagram is always, generally speaking, focused towards mental health or sexual health. So I'll just be blunt. That's the advertisements I've sort of seen. I've never used the product. And I think all the advertisements say that the product works, but so does everything that you see when you see a normal product on TV or anything like that. So I'm not saying that the product doesn't work, but at the end of the day, you kind of have to take those things with a grain of salt. So hopping specifically into the investor presentation here, let me just go into here. Is it this? Yeah. So I just went specifically into the 2Q investor presentation and went through and said, what do I think here? So just looking at the stock, I did show the Robinhood chart there. At the moment, $1.35 billion company. So in that respect, relatively smallish sort of cap sort of stock. So with respect to that, is this thing actually producing any capital? I don't really know, right? So this is kind of where it gets into exploration mode for me. And my initial thoughts, I'll get into some of the numbers and maybe dive a little bit deeper, but my initial thoughts were, this doesn't seem too bad, right? And what I mean by that is you're getting to the place where, and we'll walk through it in the presentation, you're getting through the place where you're starting to get EBITDA positive. And so with that, only in a $1 billion valuation, if you're able to continue the growth that they've been able to see, which we'll get into as well, and have the long-term EBITDA margins that they're expecting from the organization, you're going to start getting to a price to EBITDA multiple that can get very small very quickly. Now, what that would then mean is if they're able to maintain that revenue growth and they're able to maintain that margin, then you could see a price of this thing kind of explode at, I guess, as quickly as they're kind of growing, right? If they're able to maintain that sort of margin. So now that a lot of their overhead and everything is kind of taken care of, I'm anticipating, and I've done some brief calculations, and we can spread it around and kind of do some quick math and stuff of the like. But it doesn't seem too far fetched if this thing continued down the path where it should be potentially next year or 2 years from now, making about $100 million in EBITDA. Then it might look pretty attractive here to potentially look at. But that all is dependent on what's their total market, how much are people going to stay on. It looks like they have a decent retention rate, but that's just kind of the initial thought. It looks like it's a pretty decent opportunity to look at and at least establish a small position. Will I? Probably not. There's other things I currently kind of have at the moment in my portfolio that I'm kind of holding on to that are in similar positions. Like I have Rocket Lab, I have Bros, I have Palantir that are all kind of in this position. Palantir is a little bit further ahead in terms of it's been EBITDA break even for some time. Now it's getting to the point where it's net income positive and stuff of the like. But putting that sort of stuff aside, for me, it doesn't necessarily warrant. It's not something that I wouldn't potentially say I'll never invest in, but it's just not something I'm focusing on at the moment. Maybe if I dive a little bit deeper, I'll feel a little bit better about it or what have you. Because I feel like these things with Instagram and what have you, they come and they go. And so I'm going to look at the initial numbers, and then I'm going to pull up the actual SEC, because this was really only just providing an income statement, maybe a little bit about cash flow. But what I don't have is the full cash flow statement. I don't have the full balance sheet. And so I don't know what their obligations are in terms of future debt or anything of the like. So it always helps to kind of dive deep into those 10Qs to really understand some of the underlying poop that's in any sort of stock. And I recommend doing that with any company because people might think that there's something weird going on with this or that. And generally speaking, there's a lot of verbiage that they either might mention in the earnings report or they might kind of like allude to in the earnings report, but not fully discuss. Generally speaking, because if they don't disclose everything in those 10Qs, things go pretty bad pretty quick, right? So in that respect, like reading those 10Qs, if you have the time, even if you don't really understand the numbers, you might be able to understand a little bit more about the underlying value of what's going on in the organization. So anyway, I like this problem statement. They're on a mission to help the world feel great through better health. I like that. A lot of this is just sort of branding. This is a lot of the stuff that I've seen throughout Instagram and stuff of the like. But this is kind of where my initial want to look initially goes, right? 90% recurring revenue, 75% gross profit margin, in terms of like, I guess the initial sort of products themselves, less than 1 year payback. There's a lot of footnotes and stuff like that. But initially what I'm seeing is year over year, 74% subscriber growth, 80%, revenue growth, 12% EBITDA margin growth. So they were -7 in terms of EBITDA margin. So they made 113 million in terms of EBITDA. A year ago, they probably lost 7 or 8 million in EBITDA last year. Here they are returning 1.3 million subscribers, 207 million for the quarter, 5% EBITDA growth. 5% EBITDA period margin. So they're walking away with what is this, 10 million, 11 million in sort of EBITDA. And so if you kind of annualize that, knowing this is kind of recurring revenue, right? Doesn't seem like it's going to be very cyclical. you're looking at 35 to 40 million in EBITDA, right? So let's just do a quick think about that. Um, if you're at a 1.4 billion market cap and you divide that by 40 in terms of the $40 million in EBITDA, you're looking at a price to EBITDA of 35. That's not out of control, right? Especially if you're going to continue to grow the organization at the pace at which they have been growing the organization. But the problem that I have with is I don't know where they're going to top out, right? That's the problem with any company, right? If you're able to continue this 12% EBITDA margin growth per year, that, let's just take, for example, they're able to grow that an additional 12%, or even let's just say they keep that 5%, but instead of the 800 or so million dollars in revenue they're going to make, they make 2 billion in revenue. That's $100 million in EBITDA. You go down and pretty quick to a 16 times multiple in terms of price to EBITDA. Now, I know some people don't like price to EBITDA, but the problem that you kind of see with EBITDA, it kind of just rules out a lot of the initial kind of thoughts with like share-based compensation and one-off tax items and stuff of the like. And I know that EBITDA, that's before interest and taxes, depreciation. But EBITDA to me is kind of just like you know, if you were to strip everything dry, very little debt or anything of the like, how are you showing up from a business profitability standpoint? Is what you're selling profitable? And in this particular case, you're seeing you're getting a 5% margin that could probably grow. I think later in the presentation, they show it can grow probably closer to 20% to 30% in the long term. I don't know what long term means. I don't know if that means in 5 years, 10 years. But for me, I'm just going to assume eventually you get to that 20% multiple. So or not 20% multiple, 20%, so kind of keep that in the back of my mind. And let's just say you are able to get to 2 billion, then, or 3 billion, then you're starting to get to the point where you're making, $400 million a year in EBITDA or $500 million a year in EBITDA. And so then you're talking about $1.4 billion stock. It gets really cheap pretty quick, but that all requires a lot of growth and revenue, and who knows where you actually end up. So this is a slide that I thought was pretty cool. What I don't understand specifically is, how much potential volume and stuff gets to here, right? So just because there's an estimated population doesn't mean they're going to be able to access all that, right? So this is the kind of markets that they have entered to date. So continue to unlock immediate markets, future unpenetrated opportunities. You can see there's testosterone, prostate, menopause, digestion. But where they have is ED, erectile dysfunction. I think PE is premature ejaculation. For women, they have birth control, STDs, libido, dermatology, they have hair loss, acne, aging. And so all these things, generally speaking, pretty consistent across the market. There's a lot of different places that you can get it. You might be going to this particular company for this formula. You might be going to this company for a different formula. So if you're able to get a subscription-based model, get everything from one company, I can kind of understand it. Other markets that they might look at, this is a big one, considering like all the GLP-1s that like Chris always talks about. This is weight, pain management, fertility, diabetes. All of this has kind of like 100 million population sort of growth, or not population growth, this population that they can access. So interesting from that standpoint, right? And they have other opportunities that they'll look at: eczema, rosacea, PTSD, insomnia. So other things that they will try to introduce as well. And so looking specifically here, see some people that have a lot of experience: Braintree, Google, Sue Lilly, Bonobos, Google again, Jones Day, Hartford Healthcare, Dartmouth, Walgreens. I don't know what Atomic is, but Atomic. And so decent kind of people in terms of who's in the executive team. And you have a bunch of affiliations and stuff like that. So this seems like a pretty interesting sort of organization. And so far, you can't really scoff at it. I think the thing, it goes into a bunch of like the culture, technology, all that stuff. I think at the end of the day, the thing that really tries to I try to understand is where this thing can get from a valuation perspective. I know a lot of people care about, the hype. Is it going to be a 10x stock? I can't say that just by looking at this, right? And I'm not very good at being able to project long-term run rates or anything of the like in terms of where I think that the total addressable market for this could go. I don't know. I don't have that sort of experience. I'm not really a biotech guy. I don't really look at that particularly, but it seems like this is something that's working, right? So, I mean, if you're thinking about it from that perspective, it doesn't seem like it's a scam, right? And I see things all over the Instagram about it. I have yet to hear that it's a scam, right? I've only heard kind of things, rumblings that it works. So, what do you kind of think about it, right? When you kind of look at where is this thing kind of headed, and this is what I was kind of talking about specifically. They have a lot of good data around where they were versus where they have or are today, and where they potentially might continue to go. And you can kind of start to run some numbers on that to understand, hey, you know, is this appropriately valued today? Is it overvalued? And do you think in, say, a year or two, it's going to be cheaply valued? And I would say at $6.52 as it closed today at a 1.3, $1.4 billion market cap, is it a little bit overvalued? If there was no more revenue growth and there was no more EBITDA price multiple, or sorry, more EBITDA margin increase or anything like that, you could say, yeah. But the thing is that I think it's growing so quickly. Like, for example, it went from 748,000 subscribers to 1.3 million subscribers in the matter of a year's time. Even if you were to increase this another 20% or 10%, and your revenues were able to go from the 114 million that they saw per quarter last year to the 208, even if they were to increase another 30% or something like that in the next year, going to 268 from where it is today, you could start to understand that this thing can get pretty cheap pretty quick. And what I mean by that is, let's just whip out a calculator. I don't know if you guys can see the calculator. You can't see the calculator. I don't know how I can share the calculator with you guys as well. Let me see. Entire screen. Well, that doesn't really help. But maybe a little streamception here really quick. So you guys can see the inner workings here. But let me know if you guys can see all that. Yeah, you guys can see all that. Cool. So ignore the 74% year-over-year revenue growth, the 83% year-over-year, revenue growth, 74% subscriber growth. Let's just take, for example, let's just say you get to 300 million in EBITDA per quarter, which gets you to 1.2 billion in annual revenue, right? And you'll see what it looks like here with where it is today, which I think they're estimating about 40 million in EBITDA and stuff like that. Let's just say they're only going to keep it at 0.05 million. So you're at 60 million in terms of EBITDA, 0.05% or 5% EBITDA margin. You're at 60 million in EBITDA, right? So you're at 1350 in terms of the market cap. Divide that by 60, you get to 22.5 times price to EBITDA multiple. Now, let's just say, for example, you're now not just getting to 200, but let's just say you double things, not in next year or anything like that. Let's just say you double things from where they are today. They're on a pretty good trajectory. Let's just say by chance they do double and they're at 400 per quarter. Multiply that by 4. You're at $1.6 billion in revenue a year, 5% EBITDA margin. So you're at 80. You're at 1350 divided by 80. Okay. You're at a 16x sort of multiple price to EBITDA. Granted, you do have share-based compensation, you have some stuff like that, but overall, it's not awful. And I'm assuming you guys can still like you when I'm sharing this, you guys can see the calculator and stuff, right? So if you can't, you kind of got to let me know. But I'm anticipating that you can see the calculator, and then I'll probably pause a little bit for some questions. But let's just say, for example, let's say you get 2 or 3 years of an additional 25%, 30% revenue growth. So you're at 208. Let's just say you get an additional 1.25 for, say, 2 more years, maybe 3 more years to make it 400. That gets you to the 16x multiple. Let's just say you go for 25 times the next 25% for the next 20 years, or sorry, 5 years. I'm mixing up all my numbers. 25% for the next 5 years, you get to 500. That's 2 billion in revenue. At 5% multiple, you get to 100 million, right? So 1.35 billion in market cap. Divide that by 100 million, you get the 13.5 multiple. But recognize that they also, somewhere within here, they stated how they wanted to get closer to an EBITDA margin. I think it was in the 20 to 30% range. And their trajectory for 2025 is 1.2 billion. So let's just say they do in 2025 get to their 100 million, right? The stock is 1.35 today. Divide that by 100 million, you get to the 13.5 multiple. I think that's pretty damn good. But right, let's just think, for example, they are able to get to 1.6 billion in revenue, and they're able to get to the 0.2, say, EBITDA margin. That's 320 million in EBITDA, right? If that's possible, right? I'm not saying it is, but think about it. If let's just say you get to 1.6, you get to the 0.2 in terms of EBITDA margin, they maximize their efficiencies, everything's up and running very good. $320 million a year. So they're at a 1.35 divided by 0.32. The price to multiple at that point is just absurd. So in order for that to make sense, right, let's just say a 0.32, they get to that point. So keep in mind, this is probably 10 years down the road or something like that. For it to kind of make even a little bit of sense, it might be a $4 billion, $5 billion company. The problem is with all this, per se, is you also have to take into account that there is a little bit of that share-based compensation dilution going on as well. And this is the same thing in Palantir and some of these other things. So this isn't specifically just HIMSS or anything like that. So let's just kind of look into some of these numbers, these real numbers here. So Q3, so next quarter, they're hoping to get to 220 basically in revenue, and 830 in terms of fiscal year 23, and 35 to 40 million in EBITDA. We were kind of right on that. So can't complain with that. They're hoping to maintain 85% margins. And I'm trying to think where else they kind of showed. You can see the large growth in revenue over the past 2 or 3 years, the large change in adjusted EBITDA. But you can also see the stock-based compensation, right? Anywhere between $8 to $16 million a quarter. And so that eats into it as well, right? It's no different than Palantir at that point. So that's where you're seeing this net loss number kind of come in, right? Because you do have depreciation, you have other things kind of going on that impacts this specifically. But you are getting to a point where EBITDA is kind of break even. And really the only thing that is deterring you away from that to getting your net loss is the stock-based compensation. So you subtract the 16.8 from this 10.6, you get close to that 7.2 loss in terms of where they kind of were. And so you're getting close to break even in that respect as well. So I think if you wanted to be a little bit more conservative, maybe you'd utilize this net income rather than the price to EBITDA. But I think that that's a good place to start. I mean, if you truly think that the company can get to $2 or so billion worth of revenue, I don't think it's a bad place to kind of park some money. But to me, I just don't understand the long-term trajectory of the organization enough where I would truly be really happy investing money in that. A Palantir, a Rocket Lab, I can understand to an extent where those revenue streams are going to end up. With the hymns, to me, I'm like, I just see everything on Instagram. I see everything on Facebook. I'm like, to me, that gives me an underlying fear that it requires a lot of marketing in order to get it. And I'm like, I don't know if that marketing is just to establish a base and then the base is going to be very continuous, or if that's something where that's not going to go away and they're going to have to continue to market very aggressively. And in that respect, the EBITDA margin is not going to get to the 20 to 30% like they think it is. So I'm not saying it's a bad opportunity. I don't think you'll lose a ton of money at the $1.3 billion market cap valuation. But what I can't say is, are you going to 15 or 20x your money? Do I think you could potentially keep up with the S&P? Yeah, potentially. I would need somebody to educate me on where they think in the long term the company is headed from a revenue growth perspective and how long that trajectory is. So I've spent about 30 minutes walking through it, giving you some thoughts, telling you my uncertainties, telling you the things that I do like about the organization. I will sit around now and probably just see if you guys have any questions, comments, concerns. And maybe what I also should do is also look at the debt, which I don't think is in here. So if I have the opportunity to pull up the 10Q, let me do just that and pull up the 10Q and see if there's anything within here in the 10Q that concerns me right off the bat before I go into questions specifically. So one of the things that looks nice, they have a little bit of cash. They're increasing in terms of assets. They have about $200 million in cash, which is good. Not too much debt, but their debt is increasing. So what's accounts payable, accrued liabilities? Liabilities accrued can be anything. Operating leases. So there's nothing in terms of like blowing up footprint or anything like that. So, okay. Nothing too crazy, right? It's not like they're underwater in terms of their assets versus liabilities. So, looking specifically at the 6 months ended, it's almost doubled. So, from 214 million to 398 in the first 6 months of 2022 versus 2023. Their cost of revenue stayed, it did only go up about 50% comparatively to the revenue doubling. That's a promising sign, right? If you double your revenue and your cost of revenue goes up 100% as well, then no bueno. But if you're able to continue to increase that margin, your gross profit margin, that's pretty good. Can't complain with that. Sorry, I'm not sharing my screen. So yeah, I'm just talking about going from 214 to 400-ish million in the first 6 months, going from 53 million to 75 million. Your gross profit doubled and your expenses for the revenue only went up 50%, which is good. Marketing also doubled, right? So that's my concern about having to spend $200 million worth of marketing comparatively to last year, right? Is it kind of just I've been in situations before where I've made mistakes investing in companies like Wish, where the revenue was on a very good pace, it was doing really well, but a lot of it was pumping numbers up by using marketing, right? And I know marketing is a crucial piece of any organization, so I'm not saying don't do marketing, but if you let go of this marketing costs, is the value of the revenue going to go down? They say they have an 80% retention rate. I've seen that sort of numbers game before, where you think that you have a decent monthly active user count, when in reality, you're relying on, say, this massive marketing budget to really get you there. So total OpEx, 344 or so million, coupled with the 75 million, you end up with a little bit of a loss in terms of loss from operations, but that's not too bad. Let's see what other things are in here. Share count isn't going up too crazy. We went from 203 ish last year, 203 million to 208. So it's not like share based compensation is getting out of control. That's share count as well. Here's kind of share count as well. Here's a cash flow statement. Started at a $17 million net loss. Stock-based compensation for the first 6 months is 31. So you add that in, and you're actually getting a little bit of generation in terms of cash provided by the business, right? EBITDA positive. That's good. So they're getting to a point now where they're actually generating a little bit of a bottom line. Purchase of investments, maturities of investments. I'd have to dig deeper into what that specifically is. But they're building cash. So I don't think that I'm just looking for if they like issued a bunch of stock or anything like that. And it doesn't really look like so. So they're actually generating cash to the bottom line, which is what I like to see. Let's get into some of these specifics of goodwill. This is where you can kind of start to learn a lot about the organization, and dive deeper. Like if you ever have questions, go through this 10Q, and it outlines a lot of stuff. If you can see what was wholesale, what was online revenue, how much they have in corporate bonds. So I have 1.27 million specifically in corporate and government bonds. That's pretty cool. Inventory, they have finished goods 15 million, raw materials 6 million, total inventory 21 million. You can see literally like verbatim everything that they have. Amortization of the intangible assets. So they have $19 million or $20 million worth of intangible assets, and what the maturity rates are, their marketing, payroll. You can see everything. Money market funds, literally just cash. Different levels of the cash. What else is there? Common stock, RSUs, stock plans, incentive plans, options, stock options, how many are outstanding, what prices they're going to be exercised at, restricted stock units for other employees. You could literally go, and this is all American-based companies that report to the SEC. So if you have a British company or something like that that is an American deposit receipt or something like that, they might not necessarily have a 10Q. They'll have something like this, though, that'll at least help you to an extent where you can kind of understand. Yeah, so overall revenue up 83%, up 86% for the 6 months. Subscriber grew 74%. So good shit with respect to that. Else? Expansion of new categories, not guaranteed, all that shit. Adjusted EBITDA margin. So you went from -6% to 4% for the first half of the year. So it looks like they're going to stay consistent. First quarter, they looked like they were EBITDA positive as well. So it looks like you're going to stick in this realm, and I think you're probably not going to get the love. Company's not going to get the love it probably deserves in terms of adding money to the balance sheet and everything like that until its net income. The same problem that Palantir was, right? Everyone was giving them crap and they were hanging out at the $8 range until they hit net income positive. Now they're net income positive. This is really cool too. Like this is kind of the risks and uncertainties of the organization. And if you've never looked through these, this is a lot of fun because it really will be like, oh shit, I didn't even think about that potential risk of the organization. And it kind of underlyingly tells you. And it's literally pages upon pages of all these different risks and how the company is trying to mitigate them or so risks related to government regulation, pages upon pages of different material that people don't really necessarily put into perspective. But okay, I'll stop there and answer some of these questions that you guys might be thinking about. But I'll start at the top. Recognize I've been going on for 40 odd minutes or so. Yeah, Elon refused to turn Chris's Starlink on for sure. He was cool enough to show up for Finance Junkies. No, I'm just kidding. He did mention to me before that he probably was not going to be able to make it. Debt is good if controlled wisely. I think that these guys are controlling their debt pretty good. They don't really have any big problems with that. Dude, Tattooed Chef is coming back, guys. It's going to the moon. Don't be hating on him. I need to crush next earnings so I can sell between 10 to 12 range. I have 1,000 shares of 766 cost average, so be happy with that. Feel overweighted in the position as a relation to your portfolio. Yeah, it's a good point, man. I mean, I would if I was to get involved here, I'd buy a little starter position. I wouldn't necessarily go all in. Like I said, I would need a little bit more conversation with folks and due diligence on where I think the long-term trajectory of the revenue is going and where I think it could top out at. The thing that scares me is that marketing budget. So let's see. Amazed at the new companies. I wonder what the splits are for companies alike in their market share, Viagra's ownership in this market. Yeah, that's another thing I don't know, right? Like how quickly is Hims kind of encroaching on that? Preventative healthcare, medicine, ingredients tailored to your profile need, can buy a prescription over the counter, delivered directly to their door. Been building a $5,000 position in this. Auxiliary position, yeah. Need to find out if it's high quality. I don't know anybody that's taken it. I really don't. I don't know, and if they do, I don't know if they're taking it for mental health or ED or PE. Why did I have to watch 2 ads? I don't know, guy. It's just what it is. You're getting free education, so sometimes ads, you just got to do it, No Amazon. Yeah, no Amazon in that AI article early on. Surprising. I was surprised as well. Hot Chris is on. Oh, it skipped back. Yeah, they spent a ton on marketing. I see it all over the Instagrams. All over the grams. Do it for the gram. Man, it jumped back. That's that Peter Lynch D. Triple D. A big part of the thesis for me is how well they perform in new categories. Heart health, weight loss. I agree with you. I think that would be huge. I don't know Chris is big on the GLP-1 drugs, but anything that you could take orally as opposed to taking a shot, I'd be more into that. I'm a huge I have a huge fear for needles. And so anything that I could take via a pill would be much better for me. Just got your first order of Hims in the mail, giving this Peter Lynch DD. Really impressed with the whole process so far. Doctors are very responsive to the questions. Cool. Well, that's some really good things to kind of hear with respect to that. Let's see. Hims makes sense for the next gen of 20s to mid 40s of individuals all over social media. It makes sense that I'm seeing Hims everywhere. They would capture some of that audience. I think that's a good thought as well. Horny goat weed have you going all day. What's CAC? Cost of capital? I don't know if that's what you mean. The aggressive customer base is pretty shocking. I really don't know how they will keep it up. Just an impeccable record of executing and sandbagging. I had to at least get a starter position. I think a starter position is warranted, right? Like if you are okay with potentially losing money, and like I said, it kind of fears me, right? I lost money on Wish, and I'll be transparent about that. I lost a good chunk of money on Wish, and a lot of that was being propped up by marketing. And so if you're just propping up all your numbers with marketing and you stop marketing, are you ever going to truly get to the place where you want, right? People don't understand the mess and crisis. Against simple questionnaire takes months and you pay a large copay, call out of work. Yeah, that's true. Hims makes almost $1 billion a year selling products and still lose money. Not for you. I get it, man. I get it. That's the thing, though. Like once you establish a large enough base of people, you have to pay for all that overhead. So the point is are they at that point now where they're hitting that break even point and they'll persistently grow another 20, 30, 40%? But that's the thing. Have they hit their peak, right? Are they going to start getting to a place where their retention rate starts to fall off? Their marketing isn't going as far. Will they be throwing good money after bad? These are all risks that kind of scare me. Like I said, I've been exposed to companies before where they're propped up entirely by marketing and they try to run before they can walk. And, they spent $200 million on marketing. The revenue is not even that much, right? So it's like every dollar that they earn in revenue in a quarter. Well, sorry, that was for the first half of the year for 23. So it's like they've made close to $400 million in revenue. They spent half of that in marketing. That's scary, right? I've seen that before. It doesn't end well. So my hope is that retention rate is a real thing. Biggest fear, flywheel of organic growth needs to be built out and proven to warrant more of my capital. For now, it's a side bet. I like the side bet idea. Now I can obviously see a point where this thing could go and be a $4 or $5 billion market cap. If things kind of persist and the growth is there, they get to the 20 to 30% EBITDA margin. I could see that, but I don't know. I don't see it turning into because that's their niche, right? Their niche is trying to sell things at a cheaper price, and so they're not, and is it are you gonna have to come out of the pocket for that? Another piece is, or is insurance paying for it? That's another thing I don't understand. God damn it, ETF price time. Will you be doing some DD? Was that not good DD? I thought that was pretty good DD. Him's chart doesn't look good. Unfortunately, I'm a financials guy. I'm not a tech guy, so I can't, I can tell you what a resistance is and stuff like that. That's not me, man. So, I mean, maybe somebody's better with respect to that than I am. But that's just not me. Oh, customer acquisition costs. Got it. Do they say that in the presentation? Let's just take a quick look. That's that. I think that they did say that in here. Fact sheet. Did I accidentally exit out? I accidentally did exit out of it. That's fine. Presentation. We can get rid of the 10Q and go back to Hims and Hers. Financial report. It was in here somewhere. I remember seeing it. You guys are seeing this, right? Okay, cool. They have the monthly online revenue per subscriber, so $53 per month, $150 a quarter. That's the EBITDA expansion. 85% long-term retention. I thought I saw them say kind of the cost per customer, but maybe I'm wrong. 20% subscribers using personalized solutions. I'm wrong. Yeah, I thought they had it in here. That might be something I need to look at specifically when it comes to that 10Q. It might be in there. Yeah, the marketing spiral would keep me up at night, I think. Specifically now that I've gotten burned, right? With that in the past. I've been discussing with Interactive Broker about simply borrowing debt against your portfolio as a whole retirement, which means you'll never have to sell. You could do that. Or you could write covered calls. And that's another thing is it's like you don't get too risky on this particularly, but let's just say you have $1 million portfolio. You could borrow on margin and do a very far out of the money, so you don't have any cash. Let's just say all $1 million worth of stock. You could balance it a little bit to say take 5% or 10% of your portfolio value and write far out of the money. Say far specifically, don't write at the money, far out of the money on positions that you wouldn't mind owning in the long term. So if you got put those opportunities, you'd have to say buy them, in the future. But if you sold puts on say SPY, or you sold puts and with that, if you have sufficient amount of a portfolio, you could generate a couple $100 or $1,000 a month, just off of that, to help supplement anything associated with that. Or if you have dividend income, you could use whatever dividend income and write some puts on that and stuff of the like. So I don't know. That can be a dangerous strategy. Buy, borrow, die strategy. Buy stocks, diversified portfolio, stock-based line of credit for 2%, 5% of fluctuating rate, invest in hard assets, real estate, and create income. Nothing wrong with that. Portfolio purchase $3 million, goal to take $500,000, invest that into multiple down payments to diversify into real estate and that cash flow. Great deductions as well. I'm getting close to that as well. Not the 3 million piece, but taking about 50% of my portfolio, or maybe even starting off with a small position and just buying something, even if it's like a 30% down payment or 35% down payment, just so I'm kind of cash flowing to an extent. I don't need to be cash flowing heavy, but just to be building that equity position in a home. And then every time, it gets to a point where I have a sufficient amount of equity, the hope is over time, you just acquire more and more homes or pay them off. You don't have to keep wealth building, so I think about that a good bit. The thing is that I'll never probably do though, is I'll probably never fully pay off a rental or anything like that. It just doesn't make sense for me. Because I'm still so young, and so to me, I'd always want to be building some sort of equity or something like that. It just doesn't make sense. The big piece of real estate is it matches inflation, generally speaking. So if it's going up 2% and you have a 50% loan on it, technically you're getting a rate of return of 4% because you're leveraging. You're leveraging 50% of the money. So 50% additional, sorry, it's not 50%. You'd basically be getting a 2-to-1 return. So 2% turns to 4%. Now imagine if you only put down 20%, you get a 5x return on any sort of return on the capital. So a lot of people are like, oh, but the homes only appreciate with inflation. It's like, yeah, but when you only own 20% of the home in terms of equity, it's like technically that's a return of on your investment of 5x of whatever inflation is. So if you think about it that way, if you're consistently diversifying a 20%, you're always getting your loan to value down to 20% and buying more properties, and you only match inflation, and let's say inflation stays at 2%, then you're always kind of getting a 8 to 10% return just based off of that. If you own the house outright and you own all of it, yeah, you're only getting a 2% return because you're not maximizing your opportunity for leverage at that point. So thoughts about that. But anyway, your estate will wash away the loss of some of your gains. The majority of the gains will be tax-free for children, set up at a stepped-up cost basis at your death. Exactly. You learn a lot about cost basis, step up, and stuff like that when, unfortunately, parents and stuff die. Helps avoid taxes, so good work. Yeah. But anyway, sorry that it was boring. I know Hot Chris is generally the one that provides a different lens, and the banter back and forth is generally what gets people going. But hopefully this was useful for you guys. And once again, if you guys have any other questions or any ideas for stocks, feel free to let me know. This one was cool. I liked Tim's. It's something I might consider a starter position if I'm really looking to add any more positions. Right now, I'm not really looking to add any more positions, but I think it's an opportunity for people that are interested in something like that. I am a little bit fearful of the long-term potential of the company. I would look for, is it going to continue to grow? That marketing kind of bothers me as well. So anyway, I think that's where I'll kind of end with respect to that. You'll love a Rocket Lab episode. I have a few episodes already on the channel, so feel free to give that a little bit of love while you're waiting for an up-to-date analysis on Rocket Lab. Do you sell calls on SPY frequently? I try to wait for peaks. So, and also I know this week particularly, I was going to write the other day on SPY, and I know this week we have inflation numbers coming out, and so I try to stay away when big news events are coming out, because things can go haywire. Could go up, could go down. But generally speaking, there's weeks of no news or right after news, and if things kind of spike up, say it were to go like 455, 460 today, I'd probably look a week or so out and try to write at the 5 delta, a week or so out. And I'm not trying to get a shit ton of money. Like I have 300 some dollars, so it'd be 300 some shares, be 3 contracts. So it's not a lot, but I would just be looking for, $40 or so, $50 or so, something like that. Nothing too crazy, but you do that, 40 times a year, 30 times a year, you're looking at $1,500, $2,000, and that adds to the value of the portfolio. I just reinvest that back in. So I try to do that with a lot of stocks. Different stocks have different expiries for me though. But yeah. All right, guys, I'm gonna call it there. Let me know if you have any thoughts in the comment section. Cheers.